So what we do is we have, and I'll jump down to the areas of coverage first. When title insurance is put on a transaction, we still require the lawyer to do a lot of the searches. And we rely on his searches to include into our policy of coverage. And then we, of course, provide insurance over top of those opinions as well, including the coverage for that particular property. So if there was a loss in that case and something came up later on down the line, we would insure against that loss and pay whatever claim for the actual loss suffered. The other area we have is the duty to defend. So if you had to pick up a legal battle, the purchaser did, to defend his title, his or her good title, we would, First Canadian would defend that title through legal costs. And those costs are unlimited and don't go against the actual policy amount. So to give you an example of the actual loss or damage, and I gave the same example yesterday, there was a lawyer who completed a deal for his client. His client owned a supermarket, and the lawyer got an up-to-date survey. Everything looked good. Right away to the loading dock was on the parcel page, and everything looked fantastic. The deal closed. About 3 months later, the city, local city not too far from here, said, we have an issue. We have expropriated the land that is right where your right-of-way goes to your loading dock, and that's actually our property. And what happened in that case was they did expropriate the land prior to this new survey, but when the survey was moved from land registry to land titles, it didn't get moved along with it. So the lawyer did everything he could do. The search came back as clear as he or she knew it to be, but there was an issue with this expropriation. So the city was, trying to be polite about it, but that was their land. They bought it for a roundabout, for a bus roundabout, and weren't going to let it go. So what does this gentleman do who has now this family business, has a loading dock in the back that he has to run his groceries through his trucks every day? He can't operate his business. Well, because he purchased title insurance through his lawyer, we stepped in and now had to find an alternate route, a way to save the loss suffered by not being able to use this loading dock. So what we did was we moved the loading dock away from that right-of-way, moved it to the other side of the building, created a new loading dock, which meant building it out. We had to pay the diminution in value of that loss of the property, which was the loading dock and the right-of-way, pay for the construction of the loading dock, and pay for the ability to purchase a new right-of-way into the loading dock from the other side. So, of course, that cost several hundreds of thousands of dollars, all of which was covered from about a $5,000 one-time premium. So certainly something that that lawyer was smart to do, even though everything looked clean and ready to go, and the client was happy because, quite frankly, had there not been title insurance on that property, he probably wouldn't be in business today. He would have had to do all that work himself, and I don't think that that would have been beneficial to his business in the long run. So that's the actual loss or damage, to give you an example. On the duty to defend side, the lenders really like us for what's called super priority liens. So when they lend money to a purchaser, one of the issues they have is the super priority lien, so source deductions, GST, what have you, from the government, takes priority over top of their mortgage or financing. So they're in a position where if they go into default because there's an issue where the past person on title owed money through source deductions or anything through the CRA, that would cloud the title, and again, they would suffer a loss. So that happened in a situation where transaction was closed, lender lent the money upon close, and then after the fact, because of the delay in response from the CRA, after the transaction closed, they came back and said, you owe $300,000 because of non-payment of source deductions from the previous owner. Because it was still attached to the title of the property, insurance was purchased, we were able to go in and use our duty to defend clause and fight that matter through the courts. Now, what we ended up doing was negotiating with CRA for a settlement, and then First Canadian paid that settlement of those costs as well. So another example of what we can do to protect title with the insurance. And again, if insurance wasn't paid, that would have been an issue, even though the solicitor would have provided a clean opinion on title. There are some things that come up after the fact. So there are two policy types. I talked about the loan one. That's what's most prevalent. So a lender lends money on a purchase transaction or on a refinance or what have you, and they like to be protected against default. They're now starting to insist more and more and more on title insurance as part of the mortgage instructions or financing instructions. So when your client is buying a property and he's already paying for title insurance on the loan side, there's the opportunity to speak to them about the second policy, which is an owner's policy. So here's this misunderstanding that happens quite often. Your client purchases a property, it's a $2 million property, $1 million loan. That loan comes, he has to pay title insurance on that loan, and let's say it's $800, just to be a roundabout number. And I'll get into some of the dollars and cents in a bit. He's now protected the lender against default. He hasn't protected himself or herself against any issues arising from title or off title on that particular property. So in speaking in your communication with this purchaser, this is where we like you to have a understanding of the owner's policy. The owner's policy actually protects the owner against any loss or issue with title for as long as he or she owns their property. So when we talk about the pricing of these two, and I'll give you an example. If there's a $5 million loan on a particular property, our general cost is about 80 cents per thousand. So that purchaser is going to pay $4,000 for that lender policy. If the property was worth $6 million in this case, and that purchaser wanted to purchase an owner's policy, he would have to pay the owner's policy on the greater amount, which in most cases is greater than the loan and usually the purchase price. So in this case, the purchase price is $6 million. Because it's greater than 5, our pricing goes down. It's a sliding scale. As we go up, the price goes down. So that $6 million purchase price, the owner's policy would cost 70 cents per thousand. It would cost $4,200. Now he can add the loan. So that $5 million loan he or she was going to pay already on the $4,000 lender policy. He now just bought the owner and the loan policy for $4,950. So for an extra $950 one time, he's now protected not only the lender, which was part of the instructions which he or she had to do, but also protected themselves for as long as they own it. And that's the key speaking point, I think, when I talk to brokers is have an understanding on how you can protect your client in the long run. Are you responsible for title issues that come up after? Not at all. But certainly if they don't come up or they do and you're able to protect them because of the talking point that you had, it certainly would help them think highly of your reputation that you were there to help them out at the outset of the transaction. So that gives you an example. Any questions? You have to go into depth on pricing a little bit further as we go along. We talked about the one-time premium, no annual fee. On the loan side, it's transferable and assignable. So lender to lender, they can sell a book of mortgages from Scotia to CIBC, and the policies go along with them. They really like that ability to do that. On the purchase side, on the owner side, they're not transferable or assignable. They do rest with the purchaser for as long as they own that property. If they go to sell that property to the next person, we will take the existing policy, and depending if there's any changes that have taken place, and we'll offer that same policy and endorsement, which essentially are riders to the policy, to the next person at a new premium. So it's not transferable or assignable, but it is being able to take that policy and have it purchased by the following purchaser. And part of negotiations, I'll talk about it shortly, is in situations where there are issues, where there's known defects as you go into a property, you're going to list the property, and title insurance has either A, been purchased on the existing property, or B, the title issues could arise. What we're seeing a lot more now is listing lawyers or listing clients actually agreeing to purchase the title insurance policies at the outset and working that into the negotiation so that at the time of close, these issues that were going to arise get taken care of right away. So there's not a lot of price abatements at the back end because they come up, and it's worked quite well in what we've done recently with our new what we call a commitment to title insure package. So another idea here is how we save uncovering violation and setback. In this case, a 20-year-old building, lender would not release any funds because there was this cloud on title. So we came in, the deal had to close in 2 weeks. We came in and said, we looked at it, looked at the particular situation. We realized that this setback occurred. It's been there for 20 years. Underwriting team did their work ahead of time and said that we would offer an endorsement, which is essentially a rider to the policy of what's called limited marketability, which essentially says, we understand there's an issue. We'll cover over that issue as long as you own that property. At time of sale, we're not going to rectify it so you can sell it, but we'll offer that same endorsement to the next group. And for the lender in this case, we said, we'll protect and cover over this issue so you can lend on time. That closed the deal in 2 weeks rather than waiting the 30 days they had to for the municipality to get back with their decision. So just an example of closing that time period in a way in which we came to help close that deal from a lender and a purchase side. So we also have sample clauses for agreements of purchase and sale. I'm happy to send some your way. These are also able to be used in the agreement of purchase and sale to help mitigate any risk of clients walking away or lenders not wanting to lend or what have you. So if there are known risks or, known defects, for example, we can place these clauses in suggesting that if First Canadian Title can insure over them, that there's no reason to pick up and walk away from a potential purchaser. And there's a couple more. And that'll certainly help, hopefully, your business with not losing any deals, decreasing the amount of time to get those deals.